This chapter deals with liabilities, current and long-term. We'll talk about accounts payable and the accounts payable turnover, as well as notes payable and accrued interest. We'll also talk about accrued liabilities and unearned revenue, and the fun stuff, contingent liabilities. Before I get started, I would like to let you know that Maverick is on a tear today, so be prepared for some barking. I'll try to keep it to a minimum. The first slide shows you the classified balance sheet for Amazon, and you can see that current assets and current liabilities are a fairly large part of the liabilities section, with some long-term debt listed here as well. Like current assets, current liabilities are calculated based on the shorter time frame of 1 year or the operating cycle. They include day-to-day activities like buying supplies on account and creating an account payable. Anything that's not due within a year is considered long-term. So think things like mortgage, any kind of long-term debt. Oops. This slide shows some of the most current or common current liabilities for a company and which operating activity they're associated with. For example, purchasing supplies is associated with accounts payable, etc. Accounts payable turnover measures how many times in a year a company is able to pay its accounts payable. This slide shows that accounts payable for Amazon was $25,309 million. That's a lot. The formula for accounts payable turnover is illustrated on this slide. They actually made it pretty confusing. Take your purchases on credit divided by average accounts payable, and then you play with it a little bit to express it in days. This is a better illustration. In order to calculate purchases from suppliers, you have to know the beginning and ending balance of inventory. If there's not a material difference between the beginning inventory and the ending inventory, if they haven't increased or decreased very much, sometimes it's not necessary to adjust because the difference is going to have little or no effect, which makes the computation easier. Just divide cost of goods sold by average accounts payable, which would be beginning and ending plus ending divided by 2. Then divide 365 by the turnover ratio. And doing that expresses the turnover ratio in terms of the average number of days it took the business to pay its suppliers' invoices, or days payable outstanding, which is abbreviated as DPO. This shows the accounts payable turnover and days payable outstanding for Amazon. Comparing Amazon with Walmart and Target, which one would you rather do business with? Walmart pays the fastest of the two, or the three. Companies want to get paid quickly, so a shorter payment period is a better risk than a company with a longer time period. Typical credit period is 30 days, so they want to stretch it out as long as possible, but this can be tough